Climate and ESG Investing. Part 1. Understanding ESG Investing. What is ESG investing? Environmental, social, and governance, ESG, investing is a strategy where investors consider not only financial returns, but also the impact a company has on the environment, society, and its internal governance. It is a shift from traditional investing, which focuses solely on financial metrics like profits and market performance. ESG investing integrates these three key factors into the investment decision-making process. Environmental. This dimension examines how a company impacts the planet. Key areas include climate change mitigation and adaptation strategies, carbon footprint reduction efforts, resource use, e.g., water, energy, raw materials, waste management and pollution control, biodiversity protection. Social. The social pillar looks at the company's relationships with employees, suppliers, customers, and the communities in which it operates. Important social factors include labor standards and fair wages, health and safety, customer satisfaction and product quality, community engagement and impact, diversity, equity, and inclusion practices. Governance. Governance refers to how a company is run, ensuring that it operates with integrity, accountability, and transparency. Critical governance factors include board diversity and structure, executive compensation and incentives, business ethics and anti-corruption measures, shareholder rights and transparency. By integrating these non-financial factors into decision-making, ESG investors aim to support sustainable companies that manage risk effectively while delivering long-term value. Historical context of ESG investing. While ESG investing may seem like a relatively recent phenomenon, its roots trace back to the 1960s and 1970s. In the early stages, the focus was primarily on socially responsible investing, SRI, which avoided investing in companies engaged in activities such as tobacco, alcohol, gambling, and weapons production. SRI sought to align investments with personal or societal values, typically based on moral and ethical considerations. In the 1980s and 1990s, the scope of socially responsible investing expanded to include broader issues like human rights, environmental protection, and labor practices. However, it wasn't until the early 2000s that the term ESG gained prominence. Influential reports, such as the 2004 Who Cares Wins initiative by the United Nations, emphasized the importance of considering environmental, social, and governance factors for risk management and long-term financial success. By the 2010s, ESG investing gained significant traction, especially as research began showing that companies with strong ESG practices tended to perform better over the long term, both financially and reputationally. Investors started recognizing that ESG factors are not just about ethical considerations, but also about managing risk and identifying growth opportunities. The rise of ESG investing. The past 2 decades have seen ESG investing evolve from a niche sector to a mainstream strategy. Several factors have driven this transformation. Increasing awareness of climate change and environmental issues. The growing evidence of climate change, along with extreme weather events, rising sea levels, and natural resource depletion, has created a heightened awareness among investors of the risks associated with environmental damage. Public pressure on companies to mitigate their environmental footprint has led to greater transparency in environmental reporting and the adoption of sustainability practices. The shift toward stakeholder capitalism. The idea that companies should focus on the interests of all stakeholders, rather than just shareholders, has gained momentum. This includes employees, customers, suppliers, and the broader community. Investors are increasingly seeing that companies with strong ESG practices are more resilient and better positioned for long-term success, especially in navigating challenges like climate change or social unrest. Institutional investor engagement. Large institutional investors, such as pension funds, endowments, and sovereign wealth funds, have been major drivers of the ESG movement. These investors have the financial power to push for changes in corporate behavior, as they increasingly prioritize ESG factors in their investment portfolios. Leading asset managers like BlackRock and Vanguard have publicly committed to ESG integration and have pressured companies to improve their sustainability efforts. Financial performance evidence. Numerous studies have shown that companies with strong ESG practices often outperform their peers in terms of financial returns. The connection between good governance, a healthy work environment, and strong financial performance has become clearer. Investors are recognizing that ESG factors can mitigate risks, e.g., regulatory fines, environmental lawsuits, while identifying growth opportunities in sectors like renewable energy, electric vehicles, and sustainable agriculture. Government and regulatory support. Governments around the world are introducing policies and regulations that encourage or require companies to adopt ESG practices. The European Union's Sustainable Finance Disclosure Regulation, SFDR, and the U.S. Securities and Exchange Commission, SEC guidelines on ESG disclosures are examples of such developments. Additionally, initiatives like the Paris Agreement, aimed at limiting global temperature rise, have added urgency for businesses and investors to adopt sustainable practices. ESG ratings and metrics. ESG ratings provide investors with a benchmark for evaluating a company's performance on ESG factors. These ratings are offered by various independent agencies that assess companies based on publicly available data. Some of the most widely recognized ESG rating agencies include MSCI ESG Ratings. MSCI provides ESG ratings on companies from AAA leaders to CCC laggards based on factors like carbon emissions, supply chain management, and board diversity. Sustainalytics. This firm assesses a company's exposure to ESG risks and how well it manages them, with scores ranging from low to high risk. Refinitiv ESG scores. Refinitiv evaluates companies based on their environmental impact, social responsibility, and corporate governance. FTSE Russell. FTSE provides ESG ratings that consider a company's environmental and social behavior and governance practices. While these ratings can provide useful insights, they are not without limitations. Variations in methodology, data availability, and assessment focus across agencies can lead to discrepancies in ratings. As such, investors should consider these ratings as part of a broader ESG analysis and integrate them with other tools, such as direct engagement with companies or proprietary research. The role of ESG in portfolio management. ESG factors can be integrated into portfolio management in several ways. Investors can either use a positive screening approach, where they focus on companies that excel in ESG factors, or a negative screening approach, where they exclude companies involved in harmful practices. ESG integration. This involves the incorporation of ESG factors directly into the investment decision-making process alongside traditional financial metrics. It could mean adjusting forecasts and valuations to account for ESG risks and opportunities. For example, an investor may increase the weighting of renewable energy companies in their portfolio while reducing exposure to fossil fuel companies due to the risks posed by a carbon-constrained world. Thematic ESG investing. This strategy focuses on investing in specific themes or sectors that are aligned with ESG objectives, such as clean energy, sustainable agriculture, or water conservation. Thematic funds typically invest in companies directly contributing to these solutions. Impact investing. Unlike ESG integration, which seeks to mitigate risks and improve returns, impact investing aims to generate measurable social and environmental impacts alongside financial returns. Investors in impact funds intentionally direct capital to companies or projects that aim to solve critical social or environmental problems. By adopting these strategies, investors can shape their portfolios to align with their ethical values, manage long-term risks, and seize opportunities in the rapidly changing ESG landscape. Summary. This part introduced ESG investing as a strategy that integrates environmental, social, and governance factors into investment decision-making. The rise of ESG investing has been driven by a combination of increased awareness of climate change, a shift toward stakeholder capitalism, growing institutional support, financial performance evidence, and regulatory changes. Understanding ESG ratings and how they are applied in portfolio management is essential for investors seeking to align their investments with both financial goals and ethical values. Next, we will delve deeper into the climate crisis and its economic implications in Part 2. Part 2. The climate crisis and its economic impact. Scientific overview of climate change. Climate change refers to long-term changes in temperature, precipitation patterns, and other atmospheric conditions on Earth. While natural processes have historically contributed to climate fluctuations, current trends are largely driven by human activities, particularly the burning of fossil fuels, like coal, oil, and natural gas, that release greenhouse gases, GHGs, into the atmosphere. Greenhouse gases, GHGs. The primary GHGs responsible for climate change include carbon dioxide, methane, carbon tetrahydride, nitrous oxide, dinitrogen monoxide, and fluorinated gases. These gases trap heat in the Earth's atmosphere, creating a greenhouse effect. Global warming. According to the Intergovernmental Panel on Climate Change, IPCC, the Earth's average temperature has risen by approximately 1.1 degrees Celsius since the pre-industrial era. While this may seem small, it has led to severe impacts, including more frequent and intense heat waves, floods, and storms, as well as changes in ecosystems and biodiversity. The carbon cycle. The carbon cycle describes how carbon is exchanged between the Earth's atmosphere, oceans, soil, and living organisms. Human activities, particularly deforestation and fossil fuel combustion, have disrupted the natural carbon cycle, leading to elevated atmospheric carbon dioxide concentrations. Climate projections. The IPCC's climate models project that, without significant reductions in GHG emissions, global temperatures could rise by 1.5 degrees Celsius to 2 degrees Celsius by 2050. This may result in severe consequences, including rising sea levels, extreme weather events, and disruptions to agriculture and biodiversity. Economic risks of climate change. The economic risks of climate change are substantial and multifaceted, affecting everything from infrastructure to agricultural productivity. Broadly, these risks can be categorized into two types: physical risks and transition risks. Physical risks. Physical risks are the direct impacts of climate change on businesses and economies. They can be classified into two categories. Acute risk. Extreme weather events. These include hurricanes, floods, droughts, wildfires, and heat waves. For example, severe hurricanes can destroy infrastructure, disrupt supply chains, and lead to billions of dollars in losses. Droughts can impact water supplies, affecting agriculture, energy production, and industries dependent on water. Natural disasters. Coastal cities and low-lying regions are particularly vulnerable to sea level rise, which increases the risk of flooding and erosion. Chronic risks. Long-term environmental shifts. Gradual shifts, such as rising average temperatures, reduced water availability, and changing precipitation patterns, can affect agricultural yields, water resources, and energy demand. Sea level rise. Coastal cities and infrastructure face risks from rising sea levels, potentially causing billions in property damage and displacing populations. Transition risks. Transition risks arise from the global shift towards a low-carbon economy. As governments and businesses adopt policies to reduce carbon emissions and mitigate climate change, certain sectors face significant challenges. Policy and regulation risks. Carbon pricing. Governments may introduce carbon taxes or cap-and-trade systems to incentivize emissions reductions. This can increase operational costs for companies in carbon-intensive industries, such as oil and gas, coal, and manufacturing. Stricter regulations. Governments may implement stricter environmental standards for emissions, waste management, and energy efficiency. Companies that fail to comply may face penalties or be forced to incur additional costs to meet the new requirements. Technological risks. Shifting energy mix. As renewable energy technologies, such as solar, wind, and electric vehicles, become more cost-competitive, fossil fuel-based industries may face declining demand. Companies that rely heavily on traditional energy sources risk being left behind unless they invest in cleaner technologies. Innovation and disruption. Industries that do not adapt to emerging sustainable technologies may face obsolescence. For example, companies that do not transition to electric vehicles may see their market share erode as consumers and regulators demand cleaner alternatives. Market risks. Changing consumer preferences. Consumers are increasingly demanding sustainable products and services. Companies that fail to respond to these shifts may see their market positions weaken. Investor pressure. Investors are increasingly factoring climate risks into their investment decisions. Companies that fail to demonstrate effective climate risk management may face reduced access to capital. Sector-specific impacts. The impacts of climate change and the transition to a low-carbon economy will vary by sector. Some industries are more exposed to climate risks than others, while some stand to benefit from the shift to sustainability. Energy. The energy sector is at the heart of the climate change debate, given its significant contribution to global carbon emissions. Traditional oil and gas companies face increasing regulatory pressure to reduce emissions, while renewable energy companies, such as those in solar, wind, and geothermal energy, stand to gain market share as the world moves toward a low-carbon energy mix. Agriculture. Climate change is already affecting agricultural productivity, with droughts, floods, and shifting weather patterns disrupting crop yields. This is particularly problematic in regions that rely on rain-fed agriculture. Sustainable farming practices, precision agriculture, and crop diversification will be critical in adapting to these challenges. Real estate. The real estate industry is highly vulnerable to climate risks, particularly in coastal areas susceptible to flooding and rising sea levels. Commercial and residential properties may face significant depreciation due to environmental factors, leading to stranded assets. On the other hand, buildings that adhere to green building standards and energy-efficient designs may experience increased demand. Insurance. The insurance industry is highly exposed to climate risks, particularly through the increasing frequency of extreme weather events. As these events become more frequent and severe, insurers may face rising claims, which could lead to higher premiums for customers and financial losses for insurers. Finance and investment. The financial sector faces direct exposure to climate risks through its lending and investment activities. Financial institutions must evaluate the climate-related risks of their portfolios, considering both the physical risks of climate change and the transition risks of moving toward a low-carbon economy. Investors are increasingly factoring ESG risks into their decision-making processes, leading to a reallocation of capital towards more sustainable investments. Climate-related financial disclosures. As climate risks gain recognition in financial markets, it has become increasingly important for companies to disclose their climate-related risks and opportunities. Financial disclosures allow investors to assess the potential impact of climate change on business operations, helping them make informed investment decisions. One of the most widely accepted frameworks for climate-related disclosures is the Task Force on Climate-Related Financial Disclosures, TCFD, established by the Financial Stability Board, FSB, in 2015. The TCFD recommendations encourage companies to disclose. Governance. How governance structures are addressing climate-related risks and opportunities. Strategy. How climate change impacts the company's strategy and business model, considering different climate scenarios, e.g., a 2 degrees Celsius or 4 degrees Celsius global temperature rise. Risk management. How companies identify, assess, and manage climate-related risks. Metrics and targets. The metrics and targets used to assess and manage climate-related risks and opportunities, such as carbon emissions, energy use, and sustainability goals. These disclosures help investors understand how companies are managing climate risks and whether they are aligning with global climate goals, such as the Paris Agreement's aim to limit global warming to well below 2 degrees Celsius. The role of investors in addressing climate change. Investors play a critical role in driving the transition to a low-carbon economy. As stewards of capital, institutional investors have the power to influence corporate behavior through active engagement and voting on shareholder proposals related to climate change. Shareholder engagement. Investors can engage with companies to encourage them to disclose their climate risks, set carbon reduction targets, and invest in sustainable technologies. Engagement can take the form of direct dialogue with management, proxy voting, and the filing of shareholder proposals. Divestment and reinvestment. Investors are increasingly divesting from high-carbon sectors, e.g., fossil fuels, and reinvesting in low-carbon solutions such as renewable energy, clean technology, and green infrastructure. This shift not only helps mitigate climate risks, but also aligns investments with the growing demand for sustainability. Sustainable finance. The growing demand for sustainable finance products, such as green bonds and climate-focused funds, enables investors to support projects that directly contribute to climate mitigation and adaptation. Green bonds, for example, fund projects that reduce carbon emissions, such as renewable energy installations, energy-efficient buildings, and clean transportation infrastructure. Summary. In this part, we explored the scientific basis of climate change, including the role of greenhouse gases, the carbon cycle, and the potential impacts on global temperatures. We also examined the economic risks associated with climate change, including both physical risks, acute and chronic, and transition risks, policy, technological, and market changes. Additionally, we discussed how various sectors are affected by climate change, from energy to agriculture, real estate, insurance, and finance. The part also highlighted the growing importance of climate-related financial disclosures and the role of investors in addressing climate change through engagement, divestment, and sustainable finance. Next, we will delve into why climate and ESG investing matters in Part 3. Part 3. Why climate and ESG investing matters. Aligning investments with values. One of the primary reasons investors are drawn to ESG investing is the opportunity to align their investments with their values. Traditional investing focuses solely on financial returns, but ESG investing considers the broader impact of business activities on society, the environment, and governance. This approach allows investors to support companies that reflect their ethical views, whether that involves protecting the environment, promoting social justice, or ensuring responsible corporate practices. Environmental concerns. Many investors choose ESG investing because they want to support companies that are taking active steps to combat climate change, reduce pollution, and promote sustainability. By investing in clean energy, sustainable agriculture, and waste reduction technologies, investors can contribute to a more sustainable future. Social justice and equality. ESG investors are also concerned with social issues such as labor rights, diversity, equality, and fair treatment of communities. By investing in companies that prioritize these values, investors can promote positive social change and support businesses that are committed to improving the welfare of society. Good governance. Investors are increasingly focused on companies with transparent, accountable, and ethical governance structures. Companies with strong governance practices are more likely to build trust with stakeholders and avoid scandals, which can negatively impact their financial performance and reputation. By aligning investments with personal or societal values, ESG investing offers investors the opportunity to make a positive impact while pursuing financial returns. Risk mitigation and long-term value creation. While ESG investing is often associated with ethical considerations, it is also a smart financial strategy. In fact, one of the key drivers of the ESG movement is the recognition that ESG factors can help mitigate risks and create long-term value for investors. Environmental risk management. As the world faces the growing challenges of climate change, companies that fail to address environmental risks may face severe financial consequences. These could include regulatory fines, litigation, and reputational damage, all of which can harm a company's financial performance. On the other hand, companies that actively manage their environmental impact by reducing emissions, improving energy efficiency, or transitioning to renewable energy are better positioned to weather these risks and capitalize on new opportunities. Social risk management. Social risks, such as labor disputes, human rights violations, or poor customer relations, can also undermine a company's long-term viability. For example, companies that fail to maintain high labor standards may face worker unrest, strikes, and reduced productivity. Companies that prioritize diversity, equity, and inclusion are more likely to attract top talent, foster innovation, and strengthen their relationships with customers and stakeholders. Governance risk management. Corporate governance issues, such as executive compensation, board diversity, and transparency, can have a significant impact on a company's performance. Poor governance practices can lead to financial mismanagement, fraud, and scandals that damage shareholder value. Companies with strong governance structures are more likely to build trust with investors, employees, and customers, ensuring long-term stability and profitability. By considering these risks, ESG investors can make more informed decisions and build portfolios that are better equipped to weather financial, social, and environmental challenges. The role of corporate governance in ESG. Corporate governance is a cornerstone of ESG investing. Effective governance practices are essential to ensuring that companies act in the best interests of their stakeholders, including shareholders, employees, customers, and the broader community. Strong governance structures help companies avoid corruption, improve transparency, and build trust with investors and customers. Board composition and diversity. A diverse and well-functioning board of directors is essential for sound decision-making. Boards that are diverse in terms of gender, race, and professional experience are more likely to bring different perspectives to the table, leading to better decision-making. Furthermore, independent board members who are not tied to the company's management are better able to hold executives accountable. Executive compensation. Aligning executive compensation with long-term shareholder value is a key component of good governance. Performance-based incentives, rather than short-term bonuses, encourage executives to focus on sustainable growth rather than quick profits. Shareholder rights and transparency. Good governance also involves transparency in reporting and a commitment to protecting shareholder rights. Companies should disclose material information in a timely and accurate manner, enabling investors to make informed decisions. Transparent governance also builds trust and reduces the risk of regulatory scrutiny or shareholder activism. Stakeholder capitalism versus shareholder capitalism. The debate between stakeholder capitalism and shareholder capitalism lies at the heart of ESG investing. Traditionally, shareholder capitalism, which focuses on maximizing profits for shareholders, has been the dominant model in corporate governance. However, the rise of ESG investing reflects a shift toward stakeholder capitalism, which considers the interests of all stakeholders: employees, customers, suppliers, communities, and shareholders. Shareholder capitalism. In the shareholder model, the primary goal of a company is to maximize profits and shareholder returns. This often leads to short-term decision-making focused on cost-cutting, boosting profits, and increasing stock prices. Critics argue that this approach can lead to environmental degradation, income inequality, and poor working conditions as companies prioritize financial gain over social and environmental impacts. Stakeholder capitalism. Stakeholder capitalism, on the other hand, recognizes that companies have responsibilities beyond just generating profits for shareholders. It argues that companies should consider the long-term well-being of all stakeholders, including employees, customers, and the environment. By prioritizing sustainable practices, diversity, and fair treatment of workers, stakeholder capitalism aims to create value not only for shareholders but for society as a whole. The shift towards stakeholder capitalism aligns with the growing demand for ESG investing. Investors are increasingly looking for companies that balance profit-making with positive contributions to society and the environment. Evidence of strong ESG performance. There is a growing body of evidence suggesting that companies with strong ESG performance tend to outperform their peers in the long run. This is due to several factors. Lower risk exposure. Companies that manage ESG risks effectively are less likely to face costly environmental or social disasters, regulatory fines, or reputational damage. For example, companies with strong environmental practices are better prepared for the risks of climate change, while companies with good governance practices are less likely to experience financial scandals. Operational efficiency. Many companies that excel in ESG practices also enjoy operational efficiencies that improve their bottom line. For instance, companies that focus on energy efficiency or waste reduction often lower their operational costs. Similarly, companies that prioritize employee well-being and diversity tend to experience higher productivity and innovation. Attracting investment and talent. Investors are increasingly favoring companies with strong ESG profiles, as they see them as less risky and better positioned for long-term success. Additionally, companies with strong ESG practices are more likely to attract top talent, as employees increasingly seek employers that share their values. Consumer loyalty. Consumers are increasingly choosing brands that align with their values. Companies that prioritize sustainability, ethical sourcing, and social responsibility often build stronger brand loyalty and customer retention, which can translate into higher revenues and profitability. Several studies have shown that companies with high ESG ratings tend to outperform their lower-rated counterparts. For example, a 2020 study by MSCI found that companies with high ESG scores outperformed their peers in terms of stock performance and risk-adjusted returns. Furthermore, the study found that companies with low ESG scores were more likely to experience higher volatility and greater risk exposure. Investor sentiment and public pressure. The growing popularity of ESG investing can also be attributed to changing investor sentiment and public pressure. In recent years, there has been a marked shift in how investors view the role of business in society. Investors are increasingly looking for opportunities to generate not only financial returns, but also social and environmental impact. Millennial and Gen Z investors. Younger generations are particularly focused on sustainability and social issues. Studies show that millennials and Gen Z investors are more likely to seek out investments that align with their values, including companies that prioritize ESG issues. This shift in investor behavior is encouraging asset managers and financial advisors to develop more ESG-focused products and services. Activism and public opinion. Public pressure on companies to adopt ESG practices is also rising. Consumers, employees, and communities are demanding that companies take responsibility for their impact on the environment and society. This has led to greater corporate accountability, as companies realize that failing to address ESG issues can harm their reputation and financial performance. Regulatory pressure. Governments and regulatory bodies around the world are increasingly requiring companies to disclose their ESG practices and performance. In the European Union, for example, the Sustainable Finance Disclosure Regulation, SFDR, mandates that financial institutions disclose how they integrate ESG factors into their investment strategies. In the U.S., the Securities and Exchange Commission, SEC, is considering stricter rules for ESG disclosures. This regulatory pressure is further driving the adoption of ESG practices among companies and investors alike. Summary. In this part, we explored why climate and ESG investing matters, from aligning investments with personal values to managing risk and creating long-term value. We discussed the importance of corporate governance in ESG, the debate between stakeholder and shareholder capitalism, and the growing body of evidence that suggests strong ESG performance leads to better financial outcomes. We also highlighted the role of changing investor sentiment and public pressure in driving the ESG movement. Next, we will examine the global perspective on climate change and ESG investing in Part 4. Part 4. The global perspective on climate and ESG investing. The global consensus on climate change. As the evidence for climate change becomes increasingly undeniable, nations around the world are coming together to address the crisis and find sustainable solutions. International agreements, national policies, and corporate commitments are all part of the global push toward mitigating climate change and transitioning to a low-carbon economy. However, these efforts also highlight the challenges of balancing economic growth with environmental sustainability on a global scale. The Paris Agreement. The Paris Agreement, adopted in 2015, represents the most significant global effort to address climate change. The agreement commits signatory countries to limiting global warming to well below 2 degrees Celsius, with efforts to limit the temperature rise to 1.5 degrees Celsius compared to pre-industrial levels. This goal has led to an increased emphasis on reducing carbon emissions, transitioning to renewable energy, and promoting energy efficiency. National Determined Contributions, NDCs. Under the Paris Agreement, countries are required to submit nationally determined contributions, NDCs, that outline their climate action plans. While the agreement represents a step forward, there is a consensus that current NDCs are not sufficient to meet the 1.5 degrees Celsius target. This gap between ambition and action has led to calls for stronger climate policies and greater commitments from both governments and the private sector. Net zero commitments. Increasingly, governments and corporations are making net zero commitments. This means that they will aim to balance the amount of carbon emitted with the amount removed from the atmosphere, effectively reducing their net carbon emissions to zero by a certain date. Many countries, including the European Union, the UK, and Canada, have pledged to achieve net zero emissions by 2050. A growing number of corporations have followed suit, including major players in industries such as energy, technology, and finance. The role of the private sector. While government action is critical in the fight against climate change, the private sector is also playing an increasingly important role. Investors, businesses, and financial institutions are recognizing the need to integrate climate risk into their decision-making processes, and they are responding with policies, practices, and investments that align with global climate goals. ESG investing around the world. The ESG investing movement is not confined to any single region, but is instead a global phenomenon. Across different continents, countries, and regions, investors are increasingly considering ESG factors when making investment decisions, recognizing that these issues are critical to long-term value creation and risk management. Europe, leading the charge. Europe is a global leader in ESG investing, with many countries implementing policies and regulations that promote sustainable finance and corporate responsibility. The European Union, EU, has been at the forefront of efforts to integrate ESG factors into the financial system, setting ambitious goals to address climate change and enhance the role of the financial sector in driving sustainability. EU Green Deal. The European Green Deal, launched in 2019, is a comprehensive roadmap for transforming Europe into a climate-neutral continent by 2050. It includes initiatives to reduce greenhouse gas emissions, increase energy efficiency, promote renewable energy, and encourage sustainable agriculture and biodiversity preservation. Sustainable Finance Disclosure Regulation, SFDR. In 2021, the EU introduced the Sustainable Finance Disclosure Regulation, which requires financial institutions to disclose how they integrate ESG factors into their investment processes. This regulation aims to enhance transparency and encourage capital flows toward sustainable investments. EU Taxonomy for Sustainable Activities. The EU Taxonomy is a classification system for environmentally sustainable economic activities. It provides a clear framework for identifying investments that contribute to the EU's climate and environmental objectives. The taxonomy is intended to guide investors toward sustainable investments and help reduce greenwashing. North America, growing focus on ESG. In North America, ESG investing is growing rapidly, with both institutional and retail investors increasingly prioritizing sustainability factors. However, the regulatory and policy landscape differs significantly from Europe, and the level of government commitment to climate action can vary. United States. In the U.S., ESG investing has gained traction among institutional investors, asset managers, and corporations, although regulatory frameworks are still evolving. The U.S. Securities and Exchange Commission, SEC, has signaled its intention to enhance climate-related disclosures, and several states have enacted their own ESG-related policies. Corporate commitments. Many major U.S. companies, particularly in sectors like technology, finance, and consumer goods, have made net zero commitments and are taking steps to integrate ESG factors into their business operations. For example, tech giants such as Google, Microsoft, and Apple have committed to becoming carbon neutral or achieving net zero emissions by 2030 or earlier. Challenges and debates. ESG investing in the U.S. faces challenges, including political divisions, regulatory uncertainty, and the absence of a standardized framework for ESG reporting. Additionally, there has been political pushback against ESG initiatives, with some state governments attempting to limit the use of ESG criteria in public investments and pension funds. Canada. ESG investing in Canada has gained significant momentum in recent years. The Canadian government has committed to achieving net zero emissions by 2050 and has introduced policies to support the transition to a low-carbon economy. Canadian investors are increasingly prioritizing ESG factors in their investment strategies, and several large institutional investors, such as the Canada Pension Plan Investment Board, CPPIB, have made significant commitments to sustainable investing. Asia, a diverse landscape. Asia presents a diverse landscape for ESG investing, with varying levels of commitment and progress across different countries and regions. While some Asian countries have been slow to adopt ESG investing practices, others are rapidly catching up as the region recognizes the importance of sustainability in business and finance. China. As the world's largest emitter of greenhouse gases, China plays a critical role in global climate action. The Chinese government has made ambitious climate goals, including achieving carbon neutrality by 2060. The country has also made strides in promoting renewable energy, electric vehicles, and green finance. However, challenges remain in implementing these goals, particularly given the continued reliance on coal and other fossil fuels. Green bonds and green finance. China is one of the largest issuers of green bonds, which are used to fund environmentally sustainable projects. The country has developed a green finance system to support investments in renewable energy, energy efficiency, and other sustainable initiatives. Japan. Japan has made significant progress in ESG investing, particularly in the areas of corporate governance and environmental sustainability. The country's government has pledged to achieve net zero emissions by 2050, and many Japanese corporations are adopting ESG practices. The Japan Stewardship Code and the Corporate Governance Code have both played important roles in encouraging companies to focus on sustainability and corporate responsibility. India. ESG investing in India is still in its early stages, but there is growing recognition of the need for sustainable finance. India faces significant challenges related to climate change, including air pollution, water scarcity, and the impacts of extreme weather events. However, the country is making progress in promoting renewable energy and sustainable development, and several Indian companies are increasingly integrating ESG factors into their operations. ESG regulations and reporting standards. A critical element of global ESG investing is the development of standardized regulations and reporting frameworks. As the demand for ESG information grows, investors are calling for greater transparency and consistency in how companies disclose their ESG practices. Global Reporting Initiative, GRI. The GRI is one of the most widely used frameworks for ESG reporting. It provides guidelines for companies to disclose their environmental, social, and governance impacts. The GRI standards are designed to help companies communicate their sustainability efforts in a way that is clear, consistent, and comparable across industries and countries. Sustainability Accounting Standards Board, SASB. The SASB provides industry-specific standards for ESG reporting, focusing on the financial materiality of ESG issues. The SASB standards are designed to help companies disclose information that is relevant to investors, helping them assess the financial risks and opportunities associated with ESG factors. International Financial Reporting Standards, IFRS Foundation. The IFRS Foundation is developing a global baseline for sustainability disclosures. In 2021, the Foundation announced the creation of the International Sustainability Standards Board, ISSB, which will work to develop a global standard for ESG reporting. This initiative aims to provide consistent, comparable, and reliable ESG data for investors worldwide. Task Force on Climate-Related Financial Disclosures, TCFD. The TCFD provides a framework for companies to disclose the financial impact of climate change on their business. Its recommendations are becoming increasingly important for investors seeking to understand the climate-related risks and opportunities in their portfolios. The future of global climate and ESG investing. The global landscape for climate and ESG investing is evolving rapidly. As more investors, companies, and governments recognize the importance of sustainable development, the demand for ESG investments is expected to grow exponentially. However, challenges remain, including inconsistent reporting standards, regional disparities in ESG regulations, and the ongoing need for greater corporate accountability. Increasing investor demand. As climate change becomes an even more urgent global issue, investors will increasingly seek opportunities to support the transition to a sustainable future. Green bonds, impact investing, and climate-focused funds will continue to grow as investors look to allocate capital to projects that have a positive environmental or social impact. Technological innovation. Advances in technology, including renewable energy, carbon capture, and sustainable agriculture, will play a critical role in driving the transition to a low-carbon economy. Investors who can identify and support innovative solutions will be well-positioned to benefit from the growing demand for sustainability-focused technologies. Global cooperation and policy. For climate and ESG investing to reach its full potential, global cooperation and strong policy frameworks will be essential. Governments must continue to implement and enforce climate regulations, while companies must align their strategies with global climate goals. In turn, investors must continue to hold businesses accountable and prioritize investments that contribute to a sustainable future. Summary. This part explored the global perspective on climate change and ESG investing, examining the international agreements, national policies, and corporate commitments driving the transition to a low-carbon economy. We discussed the varying levels of ESG adoption across regions, including Europe, North America, and Asia, as well as the role of global ESG regulations and reporting standards. The future of climate and ESG investing will be shaped by increasing investor demand, technological innovation, and global cooperation. Next, we will delve into the specific strategies for ESG investing in Part 5. Part 5. Strategies for ESG investing. Introduction to ESG investment strategies. As the demand for sustainable investments continues to grow, investors are adopting various strategies to incorporate environmental, social, and governance (ESG) factors into their investment portfolios. ESG investing strategies allow investors to pursue not only financial returns, but also positive social, environmental, and governance outcomes. There are several approaches to ESG investing, each offering a different way to engage with the growing trend of sustainability. This part outlines key ESG investment strategies, including screening, integration, impact investing, and thematic investing. Additionally, we will explore how these strategies can be implemented by both individual investors and institutional players. ESG integration. ESG integration is the process of systematically incorporating ESG factors into the traditional financial analysis of investments. This strategy focuses on evaluating the long-term risks and opportunities posed by ESG issues, helping investors to make more informed decisions based on sustainability criteria alongside financial metrics. Holistic approach. ESG integration considers environmental, social, and governance factors in a way that is aligned with the investor's overall financial strategy. For instance, an investor may assess a company's environmental impact, labor practices, or board composition, and use this information to adjust their investment decisions. Risk mitigation. By integrating ESG factors, investors can identify risks that might not be visible through traditional financial metrics alone. For example, companies with poor environmental practices might face regulatory fines or reputational damage, leading to financial losses. By factoring in these risks, investors can avoid companies that are more likely to experience negative outcomes in the future. Positive impact. ESG integration also allows investors to identify companies that are positioned to benefit from sustainable trends, such as renewable energy or gender diversity in leadership. By investing in these companies, investors can potentially enhance their financial returns while contributing to positive social and environmental change. Tools for ESG integration. Financial firms are increasingly developing tools to integrate ESG factors into their investment process. These tools often include proprietary ESG ratings, data analytics, and sustainability metrics. Additionally, investors can use ESG-focused funds and ETFs that embed ESG integration into their investment strategies. Negative screening. Negative screening is one of the most common ESG investment strategies. It involves excluding certain industries or companies from an investment portfolio based on ethical or sustainability criteria. This strategy focuses on avoiding investments in companies that engage in practices deemed harmful to the environment, society, or governance. Common exclusions. Investors who use negative screening often exclude industries such as fossil fuels, companies involved in coal, oil, or natural gas extraction; tobacco and alcohol, companies that produce tobacco or alcoholic beverages; weapons and defense, companies that manufacture arms or provide military services; gambling, companies operating in the gambling industry; child labor or human rights violations, companies with known labor rights violations or that engage in child labor practices. Ethical considerations. Negative screening allows investors to avoid companies whose activities conflict with their personal values or ethical beliefs. For example, an investor with a strong commitment to climate action may choose to exclude fossil fuel companies from their portfolio. Socially responsible investing, SRI. Negative screening is a key component of socially responsible investing, SRI, which focuses on investing in companies that align with ethical or moral values. SRI often seeks to exclude industries that cause harm to the environment or society, such as those that contribute to pollution or violate human rights. Challenges. One limitation of negative screening is that it can result in lower diversification within a portfolio, as certain industries or sectors are excluded. This may impact financial returns, especially if excluded industries are performing well. Additionally, investors may miss opportunities to influence companies by excluding them entirely from their portfolios. Positive screening. In contrast to negative screening, positive screening focuses on identifying and investing in companies or industries that are making a positive contribution to sustainability or other ESG criteria. Positive screening encourages investors to focus on businesses that promote positive environmental, social, and governance outcomes. Sustainability leaders. Positive screening involves targeting companies that are leaders in sustainability. These companies may have strong environmental performance, such as low carbon emissions or significant use of renewable energy. They may also demonstrate strong social practices, such as fair labor policies, diversity, and community engagement. Positive social impact. Investors using positive screening may focus on companies that contribute to social good, such as companies involved in healthcare, education, or renewable energy. By investing in these companies, investors can support industries that drive societal progress and environmental sustainability. Key performance indicators, KPIs. Positive screening may involve using specific ESG metrics to assess companies. These may include measures such as carbon intensity, water usage, waste reduction, employee diversity, and human rights practices. Investors look for companies that excel in these areas and have strong ESG performance relative to their peers. Opportunities for growth. By focusing on companies with positive ESG attributes, investors can capitalize on the growing demand for sustainable products and services. For example, companies in the clean energy sector may benefit from the global transition to renewable energy, while businesses with strong governance structures may enjoy higher investor confidence. Impact investing. Impact investing is an investment strategy aimed at generating measurable, positive, social or environmental impact alongside a financial return. Unlike traditional investments, which may focus solely on financial performance, impact investing seeks to create change by directing capital to projects or companies that address pressing societal challenges. Targeted impact. Impact investments are typically made in sectors that address specific social or environmental issues, such as affordable housing. Investing in affordable housing projects that improve living conditions for underserved communities. Renewable energy. Supporting the development of renewable energy projects that reduce carbon emissions and contribute to climate change mitigation. Healthcare. Funding initiatives that provide access to healthcare services, particularly in underserved areas. Education. Supporting education initiatives, including schools and programs that provide learning opportunities to marginalized groups. Measurable outcomes. One of the key features of impact investing is the focus on measurable impact. Investors seek to track and assess the social or environmental outcomes of their investments to ensure that they are achieving the desired results. This often involves setting specific metrics or goals, such as the number of people provided with clean energy or the amount of carbon emissions reduced. Risk and return considerations. Impact investing can carry different risk and return characteristics depending on the sector or project. Some impact investments may offer competitive financial returns, while others may prioritize social impact over financial gain. Impact investors must carefully assess the trade-offs between financial performance and social or environmental outcomes. Blended finance. Blended finance is a technique used in impact investing to combine different sources of capital, such as philanthropic funds, development finance, and private sector investments, to scale up impact projects. Blended finance helps to reduce risk and attract private capital to high-impact initiatives. Thematic investing. Thematic investing involves investing in specific themes or sectors that are expected to benefit from long-term trends in environmental, social, and technological change. This strategy enables investors to capitalize on emerging trends, such as the transition to a low-carbon economy, aging populations, or the rise of digital technologies, while integrating ESG factors into the investment process. Green energy and sustainability. A popular thematic investment strategy is focusing on the green energy sector, which includes companies involved in renewable energy production, e.g., solar, wind, and hydropower, and energy efficiency technologies. As governments and businesses push for a reduction in carbon emissions, the green energy sector is expected to see significant growth. Technology for social good. Thematic investing can also target technologies that promote positive social outcomes, such as innovations in healthcare, education, and financial inclusion. For example, investments in companies developing telemedicine platforms or digital learning tools can support social impact while benefiting from the growing demand for such services. Water and food security. Another thematic investment area is focused on sectors that address critical resource issues, such as water scarcity and food security. Investments in companies that develop water-efficient technologies, sustainable agriculture, or innovations in food production can have a positive environmental and social impact. Sustainable infrastructure. Thematic investing in sustainable infrastructure involves supporting the development of environmentally friendly and resilient infrastructure projects. This includes investments in green buildings, public transportation systems, and climate-resilient infrastructure that can withstand the impacts of climate change. ESG ETFs and thematic funds. Investors can gain exposure to these themes through ESG-focused exchange-traded funds, ETFs, or thematic funds. These funds typically focus on sectors or industries that align with specific ESG criteria and benefit from long-term sustainability trends. Conclusion. In this part, we explored the various strategies used in ESG investing, from integration to screening, impact investing, and thematic investing. Each strategy offers a unique approach to aligning investments with sustainability goals, whether through mitigating risks, avoiding harmful industries, or directly driving positive social and environmental outcomes. Investors can choose the strategy or combination of strategies that best align with their financial objectives and ethical values. As ESG investing continues to evolve, new strategies and innovations are likely to emerge, offering investors even more opportunities to contribute to a sustainable future while generating long-term financial returns. Next, we will explore the challenges and limitations of ESG investing in Part 6. Part 6. Challenges and limitations of ESG investing. Introduction. While environmental, social, and governance, ESG investing has gained significant momentum in recent years, it is not without its challenges. Investors, asset managers, and corporations alike face several hurdles when attempting to integrate ESG factors into investment strategies. These challenges range from inconsistent reporting standards and data quality issues to difficulties in measuring and quantifying impact. Moreover, the debate over the financial performance of ESG investments and the role of political and regulatory frameworks adds further complexity. This part will explore the key challenges and limitations of ESG investing, helping investors and stakeholders understand the obstacles they may face in this evolving landscape. Lack of standardized ESG metrics and reporting. One of the most significant challenges facing ESG investing is the absence of standardized metrics and reporting frameworks. The lack of consistent, comparable, and reliable ESG data makes it difficult for investors to accurately assess the ESG performance of companies and make informed investment decisions. Diverse reporting standards. There are several ESG reporting frameworks available, including the Global Reporting Initiative, GRI, the Sustainability Accounting Standards Board, SASB, and the Task Force on Climate-Related Financial Disclosures, TCFD, each with its own criteria and methods for reporting ESG factors. Companies may choose to report under one or more frameworks, but the lack of alignment between these standards means that data can be inconsistent, making cross-comparisons challenging. Inconsistent disclosure practices. Many companies do not disclose ESG information in a comprehensive or transparent way. In some cases, businesses may selectively report only the data that portrays them in the most favorable light, a practice known as greenwashing. As a result, investors may find it difficult to trust or rely on the ESG data available. Lack of verifiability. Another issue is the verifiability of ESG disclosures. Some companies may provide ESG data that is self-reported and lacks independent third-party verification. This poses a significant risk for investors who rely on this information for decision-making. Without standardized and verified ESG metrics, it becomes challenging to assess the true sustainability performance of companies. Efforts toward standardization. While these challenges exist, efforts are underway to develop unified ESG reporting standards. The International Financial Reporting Standards, IFRS Foundation's establishment of the International Sustainability Standards Board, ISSB, aims to create a global baseline for ESG disclosures. Additionally, other initiatives such as the EU Taxonomy and the Global Impact Investing Network, GIIN, seek to bring more consistency and transparency to ESG data. Greenwashing and misleading claims. Greenwashing, the practice of making false or misleading claims about a company's environmental practices or sustainability efforts, has become a significant concern in ESG investing. As the demand for sustainable investments grows, some companies may attempt to capitalize on this trend without genuinely implementing sustainable practices. Superficial commitments. Some companies may tout ambitious environmental goals, e.g., carbon neutrality by a certain date, without having a concrete or actionable plan to achieve them. Others may exaggerate their sustainability efforts or selectively highlight positive outcomes while downplaying negative impacts. This can mislead investors into believing they are supporting sustainable businesses when, in reality, the company's practices may be far from sustainable. Lack of regulatory oversight. Greenwashing is made possible by the lack of regulatory oversight and inconsistent standards for ESG claims. Companies are not always required to provide third-party verification of their environmental or social practices, making it difficult for investors to differentiate between genuinely sustainable companies and those merely using sustainability as a marketing tool. Combating greenwashing. To combat greenwashing, regulatory bodies such as the U.S. Securities and Exchange Commission, SEC, and the European Union are increasingly focusing on tightening regulations around ESG disclosures. Additionally, investors can use independent ESG ratings, third-party audits, and increasingly sophisticated data analysis tools to assess the credibility of a company's sustainability claims. Limited ESG investment opportunities. Despite the growing interest in ESG investing, the universe of ESG-friendly investment opportunities remains relatively limited, particularly for investors who wish to focus on specific sectors or regions. This is especially true for certain high-impact sectors such as energy, mining, and manufacturing, where the transition to sustainable practices may be slower or more costly. High barriers for industries. Industries such as fossil fuels, mining, and heavy manufacturing are often seen as essential for economic growth and development, particularly in emerging markets. Transitioning these sectors toward more sustainable practices may require substantial investments in new technologies, infrastructure, and workforce retraining. As a result, companies in these industries may be slower to adopt ESG-friendly practices, limiting the number of viable investment opportunities. Geographic disparities. In some regions, particularly in developing markets, there is less awareness or regulatory pressure around ESG issues. Companies in these markets may lack the resources or infrastructure to implement robust ESG practices, resulting in fewer available investment opportunities that meet global ESG standards. This can present a challenge for investors seeking to build a truly global ESG portfolio. Balancing returns with ESG criteria. Some investors may struggle to find investment opportunities that offer both strong financial returns and high ESG performance. In certain sectors, especially those that are high emission or resource intensive, ESG performance may not yet align with the financial potential of the company. In these cases, investors may face trade-offs between investing in companies with solid growth prospects and those with robust sustainability practices. Emerging ESG themes. However, new opportunities are emerging in ESG-focused sectors, such as clean energy, electric vehicles, sustainable agriculture, and climate technology. These sectors are attracting significant investment and are expected to continue growing as governments and businesses implement policies aimed at addressing climate change and sustainability. Performance concerns and trade-offs. A frequent concern surrounding ESG investing is whether ESG-focused investments can deliver competitive financial returns. Critics argue that integrating ESG factors into investment strategies may result in reduced returns, especially if ESG criteria limit the pool of potential investment opportunities or exclude high-performing sectors such as oil and gas, mining, or tobacco. Short-term versus long-term gains. ESG investments often require a long-term perspective. While many ESG investments may have strong growth potential, particularly in emerging sustainability sectors, the short-term financial performance of ESG-focused companies may not always align with traditional investment benchmarks. Investors seeking quick returns may be discouraged by the slower-moving nature of ESG investing. Performance comparisons. Several studies have shown that ESG investments can perform competitively with traditional investments, and some ESG-focused funds have even outperformed their non-ESG counterparts. However, the relationship between ESG performance and financial returns is not always straightforward and can vary depending on the sector, region, and type of ESG investment. Risk and return trade-offs. ESG investors must weigh the potential trade-offs between financial returns and social or environmental impact. In some cases, investors may have to accept slightly lower financial returns in exchange for positive impact, particularly in sectors where the transition to sustainability is costly or complex. Balancing these trade-offs is a key challenge for ESG investors. Evolving investment strategies. Over time, as ESG integration becomes more sophisticated, many investors believe that ESG-focused companies will be better positioned to manage long-term risks and capitalize on emerging opportunities. Companies that lead in ESG practices may attract higher levels of investor confidence, lower capital costs, and greater resilience to regulatory or environmental risks. Political and regulatory challenges. The political and regulatory environment can significantly impact the effectiveness of ESG investing. The landscape is often fragmented, with different governments, regions, and regulators adopting varying degrees of ESG-related policies. These disparities can create uncertainty and complexity for investors trying to navigate the ESG investing landscape. Regulatory uncertainty. ESG regulations are still evolving in many parts of the world, and the lack of a unified global framework creates uncertainty for investors. In some regions, ESG-related regulations are stricter, while in others, regulations may be less robust or inconsistently enforced. This can make it difficult for investors to understand the implications of their ESG investments and whether they comply with relevant laws. Political influence. ESG investing can be subject to political influence, particularly in countries where environmental and social policies are heavily debated. Changes in political leadership or government priorities can lead to shifting regulations, making it harder for investors to predict the future direction of ESG policies. For example, a government that favors fossil fuel industries may undermine ESG initiatives aimed at reducing carbon emissions, while a government that prioritizes sustainability may incentivize ESG investments. Investor pressure. In some cases, investors themselves may face political pressure to either embrace or avoid ESG investing. For example, certain state governments in the U.S. have passed laws limiting the ability of public pension funds to invest in ESG-focused funds. Conversely, institutional investors in Europe are increasingly pressured to adopt ESG criteria to meet regulatory requirements and satisfy stakeholder demands for sustainable investment practices. Conclusion. In this part, we examine some of the key challenges and limitations of ESG investing, including the lack of standardized reporting, greenwashing, limited investment opportunities, performance concerns, and political regulatory challenges. These obstacles highlight the complexities of navigating the ESG investing landscape, but they also underscore the ongoing efforts to improve ESG practices, data transparency, and regulatory frameworks. Despite these challenges, ESG investing continues to grow and evolve, and many of these barriers are being addressed through improved standards, innovation, and investor engagement. By understanding and overcoming these challenges, investors can position themselves to make more informed decisions and contribute to the transition toward a more sustainable and responsible global economy. Part 7. The Future of ESG Investing. Introduction. As the world faces growing environmental, social, and governance (ESG) challenges, the future of ESG investing has become a focal point for both investors and businesses. With increased demand for sustainable investments, technological advancements, and evolving regulatory landscapes, ESG investing is poised for significant growth and transformation. However, the future of ESG investing will depend on how key challenges are addressed and how the broader financial ecosystem adapts to new sustainability imperatives. This part explores the future outlook for ESG investing, highlighting emerging trends, innovations, and potential shifts in investor behavior, as well as the broader role that ESG will play in the global economy. Continued integration of ESG factors across asset classes. One of the most significant trends in ESG investing is the continued integration of ESG factors across various asset classes. ESG considerations are no longer limited to equities and fixed income investments. They are increasingly being incorporated into alternative investments, real estate, private equity, and other asset classes. This growing integration will expand the scope of ESG investing and provide new opportunities for investors. Equities and fixed income. The equity and fixed income markets have been at the forefront of ESG investing. As ESG data becomes more robust, investors are incorporating ESG factors into the evaluation of stocks and bonds. ESG-focused funds and ETFs continue to gain popularity as investors seek to align their portfolios with sustainable principles. Private equity and venture capital. Private equity and venture capital investors are increasingly recognizing the importance of ESG considerations when funding startups and businesses. In particular, early-stage investors are focusing on companies that have a clear ESG strategy and the potential to scale sustainable solutions. Private equity firms are also working to ensure that portfolio companies adhere to ESG standards, with some firms using ESG criteria to guide investment decisions and engage in active ownership. Real estate. The real estate sector is experiencing growing demand for sustainable buildings and green infrastructure. ESG-focused investors are seeking properties that meet high environmental standards, reduce energy consumption, and promote social impact through community engagement and affordable housing. Additionally, commercial real estate companies are increasingly incorporating ESG metrics in property development, construction, and operations. Alternative investments. Alternative assets such as commodities, infrastructure projects, and hedge funds are also embracing ESG factors. For instance, investors in infrastructure are seeking projects that support renewable energy, energy-efficient transportation, or resilient urban infrastructure. Similarly, commodities investors are exploring ways to incorporate ESG criteria into the sourcing and production of raw materials. Impact on portfolio diversification. The widespread adoption of ESG across different asset classes will enable investors to better diversify their portfolios while maintaining alignment with sustainability goals. This expanded range of ESG-focused investment options provides flexibility in building portfolios that balance risk and return while generating positive social and environmental impact. Technological advancements driving ESG innovation. Technology is playing an increasingly critical role in ESG investing. New innovations in data analytics, artificial intelligence, AI, blockchain, and other technologies are helping investors more effectively assess ESG risks, measure impact, and track sustainability performance. Data analytics and AI. Advanced data analytics and AI tools are improving the quality and accessibility of ESG data. These technologies can process vast amounts of unstructured data, e.g., news articles, social media posts, satellite imagery, to provide real-time insights into a company's ESG performance. AI-driven platforms are also helping investors assess ESG risks and opportunities by identifying patterns in financial, environmental, and social data that traditional methods may miss. Blockchain for transparency. Blockchain technology has the potential to revolutionize ESG investing by improving transparency and traceability in supply chains and asset ownership. Blockchain-based platforms can verify the authenticity of ESG claims, making it harder for companies to engage in greenwashing. For example, blockchain could be used to track the carbon footprint of products as they move through the supply chain, providing investors with more reliable information on a company's environmental impact. Carbon footprint tracking tools. As addressing climate change becomes more urgent, technologies that track and reduce carbon footprints are becoming essential in ESG investing. Digital tools and platforms that measure carbon emissions in real time allow companies and investors to take immediate action to reduce their environmental impact. These tools help investors assess whether companies are on track to meet climate-related goals and align their portfolios with global carbon reduction targets. ESG ratings and automation. Automation is improving the efficiency of ESG rating systems. Traditional ESG ratings have been criticized for being subjective, inconsistent, and time-consuming. However, new algorithms and machine learning models are automating the process of rating companies on ESG factors, improving consistency and accuracy. Investors can use these ratings to quickly assess the ESG performance of companies and make informed decisions. Crowdsourcing and engagement. Technology is also transforming the way investors engage with companies on ESG issues. Platforms that facilitate shareholder voting, proxy engagement, and activism are becoming more widespread. Investors can use these tools to influence corporate behavior, push for stronger ESG commitments, and hold companies accountable for their sustainability practices. Evolving regulatory and policy landscape. The regulatory landscape for ESG investing is rapidly evolving, with governments and regulators around the world adopting new policies and frameworks to address sustainability concerns. These regulations are pushing companies and investors to disclose more comprehensive ESG information, while also providing greater clarity on ESG investing standards. Mandatory ESG disclosures. Governments in Europe, the United States, and other regions are increasingly mandating that companies disclose their ESG performance. The European Union's Corporate Sustainability Reporting Directive, CSRD, is a major step toward standardizing ESG reporting and increasing transparency. These regulations require companies to disclose more detailed information about their environmental impact, social practices, and governance structures. Investors will benefit from the improved consistency and comparability of ESG data, enabling them to make more informed decisions. Global taxonomy for sustainable investments. Initiatives such as the EU Taxonomy for Sustainable Activities are helping to define what qualifies as a sustainable investment. This global taxonomy aims to create a common language for ESG investing, reducing confusion and improving investor confidence. It helps investors understand which activities are considered environmentally sustainable and aligned with the EU's climate goals. Climate risk disclosure. As climate change becomes an increasingly urgent issue, regulators are requiring companies to disclose the financial risks posed by climate change. The Task Force on Climate-Related Financial Disclosures, TCFD, has been instrumental in encouraging companies to provide transparent information about their exposure to climate-related risks and opportunities. More countries are adopting TCFD-aligned reporting, which will make it easier for investors to assess how companies are managing climate-related risks. Cross-border regulations. One of the challenges in the ESG regulatory landscape is the lack of harmonization across jurisdictions. Different countries and regions have varying ESG standards and requirements, creating complexities for multinational corporations and global investors. The future of ESG investing will likely involve increased international cooperation and alignment to streamline ESG regulations and promote consistent reporting standards worldwide. The rise of sustainable financial products. As demand for ESG investments grows, financial institutions are creating an increasing array of sustainable financial products to meet the needs of investors. These products span across various asset classes, providing investors with more options to align their portfolios with their sustainability goals. Green bonds. Green bonds are a key financial product that allows investors to fund environmentally sustainable projects, such as renewable energy infrastructure, clean water initiatives, and energy-efficient buildings. Green bonds are expected to see significant growth in the coming years, as governments and corporations prioritize climate change mitigation and adaptation projects. ESG ETFs and index funds. Exchange-traded funds, ETFs, and index funds focused on ESG criteria are gaining popularity among retail and institutional investors. These funds allow investors to gain diversified exposure to companies with strong ESG performance while avoiding individual stock selection. As more ESG ETFs and index funds are launched, investors will have an expanding array of options to diversify their portfolios. Impact funds. Impact investing has become a mainstream investment strategy, with dedicated funds that focus on generating measurable social and environmental impact. These funds invest in projects or companies addressing issues such as poverty alleviation, clean energy, or gender equality. As the impact investing market grows, these funds are expected to attract more capital from both institutional and retail investors. Sustainable real estate funds. The real estate sector is seeing the rise of sustainable investment funds that focus on environmentally responsible properties. These funds target projects with low carbon footprints, energy-efficient buildings, and properties that promote social equity. Sustainable real estate funds provide an opportunity for investors to align their real estate holdings with ESG principles. The role of investors in shaping ESG standards. As the future of ESG investing unfolds, investors will play a critical role in shaping the direction of ESG standards and practices. Through engagement, advocacy, and voting, investors can push for stronger ESG policies, greater transparency, and more ambitious sustainability goals. Active ownership. Investors are increasingly adopting active ownership strategies to engage with companies on ESG issues. This includes voting on shareholder resolutions, engaging in dialogue with company management, and pushing for stronger ESG policies. Active ownership can influence corporate behavior and encourage companies to adopt better sustainability practices. Collaborative initiatives. Investors are also joining forces through collaborative initiatives to promote ESG standards. Examples include the Principles for Responsible Investment, PRI, and the Net Zero Asset Owners Alliance, which bring together institutional investors to advance ESG best practices and align investment strategies with global sustainability goals. Advocacy and policy influence. Investors are using their influence to advocate for stronger ESG policies at the regulatory level. By lobbying for policy changes and supporting sustainability-related legislation, investors can help shape the regulatory environment and promote greater transparency and accountability in ESG reporting. Conclusion. The future of ESG investing is bright, with continued growth, innovation, and regulatory advancements on the horizon. Technological developments, evolving regulations, and the rise of sustainable financial products are all contributing to a more robust ESG investing ecosystem. However, challenges such as data consistency, greenwashing, and the need for greater global alignment remain. As the market matures, investors will play a crucial role in driving the adoption of sustainable practices and shaping the direction of ESG investing. The next part will explore the role of individual investors in ESG investing, examining how individuals can incorporate ESG considerations into their personal portfolios and the growing impact of retail investors in the ESG space. Part 8. The role of individual investors in ESG investing. Introduction. As ESG, environmental, social, and governance investing continues to gain momentum, individual investors are playing an increasingly important role in shaping the future of the investment landscape. The growth of sustainable finance has opened up a wealth of opportunities for individuals who want to align their investment strategies with their values, whether through supporting companies that prioritize environmental protection, social equity, or strong governance. This part explores the role of individual investors in ESG investing, looking at how they can incorporate ESG principles into their portfolios, the tools available to them, and the impact they can have on both companies and society. We will also discuss the challenges faced by individual investors in the ESG space and strategies for overcoming them. Understanding ESG investing for individuals. For individual investors, ESG investing is about choosing investments that reflect their values while seeking competitive financial returns. It goes beyond just screening companies based on traditional financial metrics to include non-financial factors that address the broader impact of businesses on the world. Environmental considerations. Individual investors interested in the E aspect of ESG typically look for companies that actively reduce their environmental footprint, such as those involved in renewable energy, resource conservation, and pollution reduction. Investments in clean tech, renewable energy infrastructure, and sustainable agriculture are common examples of environmental-focused investments. Social considerations. For the S in ESG, investors may seek companies that prioritize social issues such as labor rights, diversity and inclusion, fair wages, and community involvement. Socially responsible investors often favor companies that promote employee well-being, human rights, and positive social impact. Governance considerations. The G in ESG refers to governance practices, including a company's corporate structure, transparency, executive compensation, board diversity, and ethical business practices. Investors who prioritize governance might avoid companies with weak oversight, lack of diversity, or problematic management structures. By combining these three elements, individual investors can craft a portfolio that not only meets their financial objectives, but also contributes to positive societal and environmental outcomes. How individual investors can integrate ESG into their portfolios. For individuals who want to incorporate ESG factors into their investment strategy, there are several approaches they can take. These approaches can vary depending on an individual's financial goals, risk tolerance, and personal values. Direct investment in ESG stocks. One way to build an ESG-aligned portfolio is by directly investing in individual stocks of companies that meet specific environmental, social, and governance criteria. Many investors research companies' ESG practices and select those that align with their values, such as those in clean energy, sustainable consumer goods, or social enterprises. ESG mutual funds and ETFs. For investors looking for broader diversification while still adhering to ESG principles, ESG mutual funds and exchange-traded funds, ETFs, are an excellent option. These funds invest in a collection of stocks and bonds that meet certain ESG criteria. There are now numerous ESG-focused ETFs available that track indices made up of companies with strong ESG practices. This approach allows individual investors to gain exposure to ESG investments without needing to pick individual stocks. Socially responsible investment, SRI funds. SRI funds take a more targeted approach to impact investing by excluding industries or companies involved in activities such as tobacco, firearms, fossil fuels, or gambling. These funds generally focus on companies that meet high ethical standards and align with socially responsible practices, making them a good option for those looking to avoid investments in certain sectors. Impact investing. Impact investing goes beyond financial returns and actively seeks to generate measurable positive social or environmental impact. Individual investors interested in impact investing often look for opportunities in areas like affordable housing, education, clean water access, and sustainable agriculture. While impact investing may carry different risk profiles than traditional investments, it is a meaningful way for individuals to create direct positive change. Community investing. For individuals interested in making a local impact, community investing allows them to direct their capital to underserved communities or businesses that contribute to social good. Community investing could include direct investment in local businesses, social enterprises, or microfinance institutions that aim to reduce poverty or provide access to basic services. Sustainable bonds. Another way individual investors can integrate ESG into their portfolios is by purchasing sustainable bonds, such as green bonds or social impact bonds. Green bonds are used to fund projects that have environmental benefits, such as renewable energy or energy efficiency projects. Social impact bonds aim to address social challenges like homelessness, education, and health. Tools and resources for individual investors. The rise of ESG investing has brought about the development of a wide range of tools and resources to help individual investors make informed decisions. These resources help investors assess ESG factors, evaluate companies, and track the impact of their investments. ESG ratings and research. Independent rating agencies such as MSCI, Sustainalytics, and Morningstar provide ESG ratings for individual stocks, funds, and other investments. These ratings assess how well a company performs on various ESG metrics, such as its carbon footprint, labor practices, and board diversity. Investors can use these ratings to make better decisions about which companies to invest in, based on ESG factors. Robo-advisors and ESG portfolios. Robo-advisors are digital platforms that use algorithms to create and manage personalized investment portfolios. Many robo-advisors now offer ESG-focused portfolios, allowing investors to select a strategy based on their values. These platforms take care of the investment management process and automatically rebalance portfolios to maintain alignment with ESG criteria. Impact measurement tools. As the demand for impact investing grows, new tools are emerging to help individual investors track the social and environmental outcomes of their investments. Platforms like the Global Impact Investing Network, GIIN, provide resources for measuring the effectiveness of impact investing efforts, ensuring that investors can see the tangible results of their capital. Online ESG investment platforms. Many online platforms are dedicated to ESG investing, allowing individual investors to browse a wide range of funds, stocks, and bonds that align with their values. These platforms often provide educational resources and research tools to help investors make informed decisions. Examples include platforms like Swell Investing, OpenInvest, and Earthfolio. The growing influence of individual investors in ESG. Individual investors are increasingly exerting influence on the ESG landscape. As more people become aware of the environmental and social impact of their investments, they are demanding greater transparency and more sustainable investment options. Retail investor activism. Retail investors have become more vocal in pushing companies to adopt sustainable practices. Shareholder activism, which involves individual investors using their ownership stake to push for changes in corporate behavior, is becoming more common. Retail investors can file proposals for companies to improve their ESG practices, pushing them to address issues like climate change, diversity, and worker rights. Voting with capital. As more individual investors place capital in ESG-aligned funds, they are sending a clear message to businesses that sustainable practices matter. Investors are increasingly considering how a company's ESG practices align with their values, and in turn, their investments reflect this. This voting with your wallet trend is driving businesses to adopt more sustainable practices as they seek to attract capital. Advocacy for policy change. Individual investors are also becoming involved in advocating for stronger ESG regulations at the government level. By supporting organizations that lobby for climate action, social justice, or stronger corporate governance standards, individual investors can help accelerate policy changes that benefit both society and the environment. Challenges faced by individual investors. While individual investors have a growing array of options and resources for ESG investing, they face several challenges that can make it more difficult to fully embrace ESG principles. Lack of standardized ESG data. The absence of consistent and standardized ESG data can be a major hurdle for individual investors. Without reliable information, it can be difficult to accurately assess the ESG performance of companies and investment vehicles. While initiatives to standardize ESG reporting are underway, investors still face challenges in navigating the complexity of ESG data. Greenwashing. The risk of greenwashing when companies make misleading claims about their ESG efforts remains a significant concern for individual investors. Investors must be vigilant in researching companies and funds to ensure that their investments are genuinely aligned with their ESG values. Complexity of ESG investing. The complexity of ESG investing, with its multiple criteria and evolving standards, can be overwhelming for individual investors. Understanding the nuances of ESG investing and how to incorporate it into a diversified portfolio requires a certain level of expertise and research. Performance concerns. Some individual investors worry that prioritizing ESG factors may limit their investment opportunities and result in lower financial returns. While many studies have shown that ESG investing can deliver competitive returns, the perception that ESG-focused investments are less profitable persists among some investors. Conclusion. Individual investors play a crucial role in the future of ESG investing. As demand for sustainable investments continues to rise, more options and tools are becoming available for individuals to integrate ESG factors into their portfolios. By choosing investments that reflect their values, individual investors not only drive positive change in companies, but also contribute to shaping the broader financial ecosystem. Despite the challenges, such as data inconsistency and the risk of greenwashing, individual investors have the power to create significant social and environmental impact through their investment decisions. As awareness grows and as more resources become available, individual investors will continue to play an essential role in advancing the ESG movement. Part 9. ESG Risks and Opportunities for Businesses. Introduction. As ESG, environmental, social, and governance investing continues to reshape financial markets, businesses are increasingly recognizing that their sustainability practices not only affect their brand reputation and regulatory compliance, but also their long-term financial performance. Today, ESG risks and opportunities are integral to a company's strategy, governance, and growth trajectory. Firms that fail to recognize or manage ESG factors risk alienating stakeholders, missing growth opportunities, and facing increased regulatory scrutiny. Conversely, companies that successfully align their operations with ESG principles can unlock new markets, enhance their resilience, and attract loyal investors. This part explores how businesses can navigate the landscape of ESG risks and capitalize on ESG opportunities. We will delve into how integrating ESG factors into business operations can lead to competitive advantages, mitigate risks, and ultimately create value for both shareholders and society at large. Understanding ESG risks for businesses. ESG risks refer to the potential adverse impacts that a company's environmental, social, or governance practices can have on its financial performance. These risks can be both tangible and intangible, and they can manifest in a variety of ways, from environmental disasters to regulatory fines or reputational damage. Environmental risks. Climate change. Businesses are facing increasing pressure to manage their exposure to climate-related risks. These include physical risks, e.g., natural disasters, rising sea levels, and transition risks, e.g., regulatory changes, market shifts toward low-carbon technologies. Companies in high-emission sectors, such as oil, gas, and manufacturing, are particularly vulnerable to climate-related risks, including carbon pricing, emission reduction requirements, and changing consumer preferences for sustainable products. Resource depletion. As natural resources become scarcer, companies that rely heavily on them may face supply chain disruptions or increased costs. Industries such as mining, agriculture, and energy production are especially susceptible to resource depletion risks. Water scarcity, for example, is a growing concern for companies in water-intensive industries, leading to higher operational costs or constraints on production. Pollution and waste. Companies that produce high levels of waste or contribute to air, water, and soil pollution face regulatory risks and potential damage to their brand reputation. For instance, industrial accidents such as oil spills or chemical leaks can result in hefty fines, legal liabilities, and long-lasting reputational damage. Social risks. Labor practices. Poor labor practices, such as unsafe working conditions, low wages, and exploitation, can result in significant risks for businesses. Companies that are found to be violating labor laws or that fail to uphold workers' rights can face legal penalties, operational disruptions, and a loss of consumer trust. In some cases, global supply chains may face scrutiny if subcontractors or suppliers engage in exploitative labor practices. Customer relations. Companies that fail to address social issues, such as diversity and inclusion, human rights, or customer data protection, can face consumer backlash, regulatory investigations, and legal action. In the era of social media and greater consumer awareness, negative public opinion can result in declining sales and reputational damage. Product liability and safety. Social risks also encompass issues such as product safety and consumer protection. A company that sells products that harm consumers or fails to take adequate measures to ensure product safety risks lawsuits, regulatory sanctions, and a damaged brand image. Governance risks. Board composition and leadership. A lack of diversity in the boardroom, weak governance structures, or poor decision-making can lead to significant risks for businesses. Poor governance practices may result in strategic mismanagement, financial instability, and a loss of investor confidence. Corruption and bribery. Companies that engage in corrupt practices or fail to implement adequate anti-corruption controls can face severe legal consequences. Bribery, fraud, and lack of transparency are governance risks that can result in significant fines, loss of business opportunities, and reputational harm. Regulatory compliance. Companies must stay ahead of an evolving regulatory landscape that increasingly includes stringent ESG-related regulations. Non-compliance with ESG regulations, such as carbon emissions limits or anti-bribery laws, can result in financial penalties, litigation, and loss of market access. ESG opportunities for businesses. While ESG risks present significant challenges, businesses that proactively address these factors are also well-positioned to capture opportunities that drive growth and create long-term value. Integrating ESG considerations into business strategy opens up new avenues for innovation, market differentiation, and operational efficiency. Innovation and product development. Sustainable products and services. Consumers are increasingly demanding sustainable products and services that align with their values. Companies that invest in green technologies, eco-friendly products, or energy-efficient solutions can tap into growing markets and attract environmentally conscious consumers. For example, companies in the electric vehicle, renewable energy, or sustainable agriculture sectors are benefiting from strong demand driven by environmental concerns. Circular economy. Adopting a circular economy model, where products are designed for reuse, recycling, or repair, can reduce waste, lower costs, and create new business opportunities. Businesses that embrace circularity can reduce their dependence on raw materials and energy, while generating new revenue streams from recycled products or services. Green innovation. Companies that innovate in environmental technologies or sustainable business practices often gain a competitive advantage. This can include developing clean energy solutions, reducing carbon emissions, or creating energy-efficient manufacturing processes. Green innovation can differentiate a business in a crowded marketplace, attracting customers and investors alike. Cost savings and efficiency. Operational efficiency. Adopting sustainable practices can lead to significant cost savings. For example, reducing energy consumption, improving waste management, and optimizing supply chains for sustainability can lower operational costs and improve margins. Businesses that focus on resource efficiency and waste reduction not only save money, but also improve their environmental impact. Supply chain resilience. Integrating ESG criteria into supply chain management can improve resilience. Companies that work with suppliers who adhere to responsible environmental, social, and governance practices are less likely to face disruptions from supply chain issues, regulatory fines, or reputational damage. Sustainable supply chains also attract investors who prioritize responsible sourcing. Regulatory incentives and tax breaks. Governments are increasingly offering incentives for companies that adopt ESG-friendly practices. These may include tax breaks, subsidies for renewable energy investment, or regulatory exemptions for businesses that meet specific sustainability standards. By aligning operations with sustainability goals, businesses can access these financial benefits, improving their profitability. Attracting capital and investment. Access to ESG capital. Investors are increasingly allocating capital to companies that demonstrate strong ESG performance. By improving ESG practices, businesses can attract investments from ESG-focused funds, impact investors, and institutional investors looking for sustainable opportunities. A robust ESG strategy can also help companies gain access to favorable financing terms. Enhanced reputation and brand loyalty. A commitment to ESG principles can improve a company's reputation, enhance brand loyalty, and attract customers who value corporate responsibility. In particular, millennials and Gen Z are highly attuned to a company's social and environmental impact, and they are more likely to support businesses that align with their values. This can lead to increased market share, customer retention, and premium pricing opportunities. Employee engagement and talent acquisition. Attracting top talent. Many employees, particularly millennials and Gen Z, are seeking employers with strong ESG commitments. Companies that prioritize diversity, inclusion, environmental sustainability, and social responsibility are more likely to attract top talent. A company's reputation for good governance and ethical practices can also lead to better employee retention and satisfaction. Employee engagement. A focus on ESG can also improve employee morale and engagement. Companies that foster a positive social impact, contribute to community development, or focus on employee well-being create a culture of purpose and pride. Engaged employees are more productive and committed, driving business success. Best practices for managing ESG risks and capitalizing on opportunities. To effectively manage ESG risks and leverage ESG opportunities, businesses need to implement best practices that integrate sustainability into their core strategies and operations. Governance and leadership commitment. Successful ESG integration starts at the top. Company leadership must demonstrate a commitment to sustainability by embedding ESG into the company's vision, strategy, and governance structure. Board-level oversight of ESG issues ensures that sustainability goals are aligned with business objectives and properly resourced. ESG integration into risk management. Companies should treat ESG risks as part of their broader risk management framework. This includes identifying and assessing ESG-related risks, such as environmental hazards, social issues, or governance lapses, and implementing mitigation strategies. Businesses should also regularly review their exposure to ESG risks and adjust their operations accordingly. Transparency and reporting. Regular and transparent reporting on ESG performance is essential for building trust with stakeholders and demonstrating a company's commitment to sustainability. Businesses should align with recognized frameworks, such as the Global Reporting Initiative, GRI, or the Task Force on Climate-Related Financial Disclosures, TCFD, to ensure their ESG reports are consistent and credible. Engagement with stakeholders. Engaging with stakeholders, including investors, employees, customers, suppliers, and communities, helps businesses understand their ESG expectations and concerns. By listening to stakeholder feedback and integrating it into their ESG strategy, companies can build stronger relationships and enhance their sustainability performance. Conclusion: ESG risks and opportunities are becoming central to business strategy. Companies that proactively address ESG risks, from climate change to governance challenges, are better equipped to navigate the evolving business landscape. At the same time, those that capitalize on ESG opportunities can unlock new growth potential, improve operational efficiency, and build stronger relationships with investors, employees, and consumers. As the pressure for businesses to embrace sustainability continues to grow, the companies that successfully integrate ESG into their operations will be better positioned for long-term success, resilience, and profitability. By recognizing and managing ESG risks and pursuing the opportunities they present, businesses can play a critical role in advancing a more sustainable and equitable future. Part 10. The Future of ESG Investing, Trends and Emerging Challenges. Introduction. As ESG, environmental, social, and governance investing continues to evolve, it is reshaping the global investment landscape in profound ways. What was once considered a niche approach to investing has now become a mainstream strategy, driven by increasing awareness of sustainability issues, growing investor demand, and the imperative to address climate change and social inequality. The future of ESG investing is poised to undergo significant transformation, with new trends, regulatory developments, and innovations shaping the way investments are made. In this part, we explore the future of ESG investing, focusing on the emerging trends that will define the next phase of the movement, as well as the challenges that investors, businesses, and regulators will face. We will also discuss how technological innovations, evolving investor preferences, and the global regulatory landscape will shape the future of sustainable finance. Key trends shaping the future of ESG investing. Several key trends are emerging that are set to influence the trajectory of ESG investing in the coming years. These trends not only reflect the growing importance of sustainability, but also highlight how ESG principles are becoming increasingly integrated into the fabric of financial markets. 1. Integration of ESG into mainstream investment strategies. ESG investing is no longer considered a niche or alternative investment strategy. As demand for responsible investing has increased, mainstream asset managers and institutional investors are increasingly integrating ESG factors into their investment processes. This integration is moving beyond exclusionary screening and focusing on incorporating ESG factors into financial analysis and decision-making across all asset classes. Major asset managers such as BlackRock, Vanguard, and State Street Global Advisors have committed to integrating ESG factors into their investment strategies, signaling a shift toward a more sustainable investment landscape. ESG criteria are being used to assess financial risks, with a growing recognition that companies with strong ESG practices tend to outperform in the long term. 2. Enhanced regulatory oversight and reporting standards. Regulatory pressure on ESG disclosure is growing, and the future of ESG investing will be heavily shaped by increased oversight and standardized reporting requirements. Governments, regulators, and global standard-setting bodies are working to develop uniform reporting frameworks that enable investors to make better comparisons across companies and asset classes. The European Union has already introduced the Sustainable Finance Disclosure Regulation, SFDR, which requires financial institutions to disclose how they integrate sustainability risks into their investment processes. Similarly, the International Financial Reporting Standards, IFRS Foundation, and the European Financial Reporting Advisory Group, EFRAG, are working to establish global ESG reporting standards to enhance transparency and reduce the risk of greenwashing. In the U.S., the Securities and Exchange Commission, SEC, has signaled a stronger focus on mandatory climate-related disclosures for public companies, indicating that regulatory scrutiny around ESG is only set to increase. 3. The rise of impact investing. While ESG investing is focused on aligning investments with sustainability criteria, impact investing goes a step further by seeking to generate measurable positive social or environmental outcomes alongside financial returns. This growing segment is attracting increasing interest from investors who want to contribute to solving global challenges such as poverty, climate change, and inequality. The future of impact investing will likely see a greater emphasis on measuring and quantifying the social and environmental impact of investments. The development of standardized impact measurement tools, such as the Global Impact Investing Networks, GIIN, Impact Reporting and Investment Standards, IRIS, will enable investors to assess the effectiveness of their investments and ensure that their capital is making a meaningful difference. 4. The evolution of sustainable financial products. The demand for ESG-aligned financial products continues to rise. In response, financial institutions are developing innovative products that allow investors to access sustainable investments in new and diversified ways. These products include green bonds, social impact bonds, ESG-themed ETFs, and sustainability-linked loans. The future of ESG investing will see the development of even more specialized financial products, such as climate-focused funds, biodiversity-themed ETFs, and ESG indices focused on specific regions or industries. With the continued growth of sustainable finance, the breadth of available products will enable investors to fine-tune their portfolios to match specific ESG criteria and investment objectives. 5. Growth of sustainable and green finance. Green finance, which includes investments in renewable energy, sustainable infrastructure, and low-carbon technologies, is expected to continue its rapid expansion. In the wake of the Paris Agreement and growing global commitments to carbon neutrality, governments and financial institutions are increasingly allocating capital to projects that support the transition to a low-carbon economy. In the future, green finance will expand beyond traditional renewable energy projects to encompass broader initiatives such as sustainable agriculture, electric mobility, energy-efficient buildings, and carbon capture technologies. The global green bond market, which has already surpassed $1 trillion in issuance, will continue to grow as governments and corporations seek to finance climate mitigation and adaptation projects. Emerging challenges in ESG investing. As ESG investing gains traction, it also faces a set of emerging challenges that could impede its future development. These challenges stem from issues such as data inconsistency, greenwashing, and a lack of standardization in ESG metrics, all of which must be addressed to ensure that ESG investing fulfills its potential. 1. Greenwashing. Greenwashing refers to the practice of companies or investment funds making misleading claims about their environmental or social impact to attract ESG-focused investors. As demand for sustainable investments grows, the risk of greenwashing increases, with companies trying to present themselves as more sustainable than they actually are. Greenwashing is particularly problematic because it undermines the credibility of the ESG investment ecosystem and can lead to poor investment outcomes. Investors must be vigilant in verifying the authenticity of ESG claims by companies and funds, and regulatory bodies are likely to increase scrutiny in the coming years to ensure that greenwashing is minimized. 2. Lack of standardized ESG data and metrics. One of the biggest challenges facing ESG investing is the lack of standardized data and metrics. There is no universal set of criteria for evaluating a company's ESG performance, and existing rating systems can be inconsistent and subject to interpretation. Investors and companies alike need reliable, comparable, and standardized ESG data to make informed decisions. Efforts are underway to develop common frameworks, such as the Task Force on Climate-Related Financial Disclosures, TCFD, and the EU's Corporate Sustainability Reporting Directive, CSRD, but the lack of uniformity remains a major obstacle. In the future, the development of universal ESG reporting standards will be critical for the growth of ESG investing. 3. The challenge of defining ESG materiality. Not all ESG factors are equally material to every company or industry. What constitutes a material ESG risk or opportunity for a technology firm may be vastly different from what is material for an oil company or a retail business. Investors face the challenge of determining which ESG factors are most relevant to each specific industry or company. Over the coming years, investors will need to develop more sophisticated tools to assess materiality in ESG investing. Companies will also need to focus on identifying and addressing the ESG factors that are most pertinent to their business model and long-term sustainability. 4. Regional variations in ESG standards. ESG standards and regulations vary significantly across regions and countries. While Europe has been a leader in driving ESG regulation, with initiatives such as the European Green Deal and the SFDR, other regions, such as the United States and emerging markets, are still catching up. This lack of global uniformity creates complexities for businesses and investors operating internationally. In the future, it will be crucial for international cooperation to harmonize ESG standards and regulations. Global initiatives such as the UN Principles for Responsible Investment, PRI, and the TCFD are already fostering greater alignment, but more work is needed to ensure that ESG standards are consistent across borders. 5. Balancing financial performance with social and environmental impact. One of the ongoing debates in ESG investing is the trade-off between financial returns and social or environmental impact. While many studies have shown that ESG investments can deliver competitive returns, there are still concerns among some investors that prioritizing sustainability could lead to lower financial performance. As ESG investing matures, it will be important to continue demonstrating that sustainable investments can deliver both financial returns and positive social or environmental outcomes. Investors will need to balance their desire for profit with their commitment to making a positive impact, and companies will need to continue improving their ESG practices to create long-term value for both stakeholders and shareholders. Conclusion. The future of ESG investing is bright, but not without its challenges. As the movement continues to gain momentum, key trends such as the integration of ESG factors into mainstream investment strategies, the rise of impact investing, and the growth of green finance will drive the evolution of the investment landscape. At the same time, challenges such as greenwashing, data inconsistency, and the lack of standardized ESG metrics must be addressed to ensure the credibility and effectiveness of ESG investing. For ESG investing to achieve its full potential, it will require continued innovation, collaboration, and a concerted effort from investors, businesses, regulators, and other stakeholders. With the right regulatory frameworks, standardized reporting systems, and a focus on materiality and transparency, ESG investing has the power to transform the global financial system and create a more sustainable, equitable, and resilient world for future generations.